For being here, and I think I'll probably just start by introducing the panel. We have Kirill here from Systema Asia Fund, which is a India fund representing the Russian Systema group. We have Gopal here, who's representing Gaja Capital. We have Babar from Khazana and Ashish from IcyCap. Welcome everybody, and thanks for being on the panel today. So I think I'll just, we've had a long day and lots of different panels, but I think this is a very important question, and it comes to everyone's mind, Indian, global, what is the view of India as an investment destination? And we have, lots of different perspectives over here. To start with, just to set the tone, I'll just say, quote some statistics here. That in 2017, we had over 26 billion of VC and PE investment in India. In 2018, quarter two itself, it's been 8.2 billion, which was used to be an annual number till 5 years ago. We have investors like Warren Buffett, who's just come into Paytm, really showing the belief of global investors in the India story. So I think that things are looking very good. People are believing in India. People are believing in the sustainability of the India story. But it'll be, with that, I just want to open the ground to maybe, starting with Gopal. So what has been your experience investing in India? What are the key themes? What are the key models that have emerged over the last few years?
So there are two questions here. What's been my experience as far as investing in India is concerned, and
okay.
In terms of models, changes, etc. So over 25 years, the industry's really come a very long way. When I started investing, you could invest in India. All you needed to invest was a checkbook. This was a capital scarce environment. And almost everything was in scarcity. There were few entrepreneurs, there was very little capital, there was a small market. The law was even more unclear than it is today. And I think on all those fronts, things have changed. I genuinely see an entrepreneurial culture, a deeper entrepreneurial culture. I always say that, one interesting dipstick is, what does the average IITian want to do on campus? 25 years ago, the average IITian still wanted to go abroad. I think today, the average IITian on an Indian campus wants to be an entrepreneur. So things have changed as far as entrepreneurs are concerned. There is a lot more capital. But more importantly, we are a $2.5 trillion economy. So let me balance the picture. I think investing so far in India has been, personally for me, a thrilling experience. But for venture capital, private equity as a whole, as an industry, has been a mixed experience. However, I do think, and I'll just leave it here, and I'd love for others to comment, I do believe that for a variety of reasons, the experience going forward, now that we are a much larger economy, private equity is a product for large economies. Private equity returns in the world are highly correlated to the size of economies. 90% of performance in private equity comes from large economies. And the good news is we are finally a large economy. So going forward, I think the results will be so much better for some of the reasons that are described. But so far, the results have been mixed.
Great, thank you. What about you, Babar? Why didn't I pose the same question to you?
So our experience in India, I would say overall it's been very decent actually. And now of course you could look at very specific cases, or we've, a little bit about ourselves. We are a little more into growth stage and later stage investing, and not so much on the VC side. Even though we've dabbled once or twice on that side when we are very, when we believe in a particular investment theme, and do not find something which is more scaled up in that theme to invest into. Those exceptions we do make. So our investment experience across has been very decent. And in terms of how we are seeing this evolve, and I say not only for my own fund, I think, earlier it used to be what I've seen is earlier investors used to be, okay, let's find a good team, let's invest behind them. And then sometime the tendency would be to start getting too deeply involved or too deeply almost, let's say, embedded into the teams that were running, and sometimes that probably was not the best. And then the shift began the other way, saying let's actually not be so intrusive and so intensive, and then the shift went the other way. And I think today I'm seeing the investment community and the entrepreneurial world is finding that balance of what is it where the investors should start getting involved and also be welcomed by the entrepreneurs to do that versus completely hands off. And that balance I see is gradually evolving. That to me is the big shift in the last 4 or 5 years.
Right. Thank you for that. So Kirill, what about Systema? What approach does Systema follow? And I think you've been, you personally have been here for the last 3 years. So what are the key learnings? How has the market evolved? How is, back in Russia, how is your parent company looking at India?
Right. So first of all, a little bit of a context. So Systema is the largest Russian conglomerate, very similar to Tata's or Godrej or Reliance here. So it's a diversified holding, a big conglomerate. It's 25 years old and London Stock Exchange listed. I joined headquarters in Moscow in 2014. In 2015, started developing the idea of the fund, and we launched the fund by the end of the 2015. As of now, as we speak, we are probably the most active Series B fund in country. So with less than 3 years in action, we have invested in 9 companies, and 1 more company is yet to be announced. So it's going to be a portfolio of 10 companies in Series B and C stage, which is a mid stage. Of course, so far so good. I mean, I cannot complain. It's been wonderful time, and for me as a professional, and for the whole team as a new asset class, because for Systema venture capital actually was a new asset class. It used to be a private equity in the old days. But of course, the performance can be measured only in full cycle experience. We don't have yet full cycle experience, but at the same time, and this is a very good metric and very good kind of signal to us, is that out of 9 current portfolio companies, 2 of our portfolio companies are already on the exit track, on M&A kind of track. Right. And hopefully, there are early signs that it's not going to be kind of home runs, but it will be a very decent return for us, and we are happy about it. So I think we are fine of not being a top quartile fund as our first fund, but again, so far so good. And just a couple of steps back. Systema actually burned out in India, as you might know. So Systema has invested in Indian telecom in 2008 and burned $4 billion here in India. This is a very sad context of our fund being launched after this. But nevertheless, the headquarters, our chairman, and all the senior management actually are very bullish about India as a big economy, and I cannot agree more with my colleagues here that the opportunity, the upside of for the private equity and venture capital investments are mostly connected with the size of the economy, and of course India being one of the largest economies and developing at the fastest kind of rates, definitely is the hottest kind of place in every sense. Thank you.
But I think that's sort of very helpful to know. But Ashish, with getting I would say a global perspective on how investors are looking outside, I'd just like to shift the attention to India. What about domestic participation, both financially and strategic? how should we, what does India think of India? I think that's another question which we should address. I know it's off topic, but I'd love to know your thoughts on that.
No, I think India is usually a lot more critical about India, but in most things. But having said that, we must understand that this is an asset class which takes time to deliver returns and to evolve, because much of the returns are derived returns from what the ecosystem is doing and how that is scaling up. Whether it is the entrepreneurial ecosystem or whether it is various industries or whether it is other markets where you exit, right? So in that context, I think I'm extremely bullish. I think we are on a cusp of a massive growth within India. There are, if you think about it, there are lots of tailwinds behind us. If you look at scale that was pointed out in terms of we have reached a certain scale. The second is technology, of course, right? Technology is disrupting every industry, and it gives entrepreneurs a chance to come in and create great companies out of nothing. The third is really the entrepreneurs themselves. I mean, like was pointed out, 10 years back we were still debating whether IITians make good entrepreneurs or whether they could make good leaders or good managers, etc., etc. Not the case anymore. And after that is really the capital, which is going after some of these things. So I think if we put these four ingredients together and project it and see what it will achieve over the next 10 years, I think we are seeing a tsunami.
And absolutely. And maybe, and do you think this has been appreciated by the private capital? Maybe that's, Gopal, for you, to even by the private capital in India, and are we going to see more participation of that with these trends now, coming about? Absolutely.
We talked about the good news and the bad news, right? So the good news is the mic is back.
Bullish on India.
And so why will things change, or what needs to change for things to change? I think one part of it is, of course, awareness. But the other two, I think, are also important. And they're less to do with awareness and, and education and so on and so forth. They are to do with conviction and performance of equities as an asset class in India. So again, anecdotally, what I love to do is whenever I interview, people who want to work in private equity firms, or I meet them, I love to understand what do they do with their own money. And it's very interesting to see what Indian fund managers, typically GPs, do with their own money, right? So I've hardly met any, I've met very few Indian private equity GPs who put their money in equity. So if you go across Bombay, you will see that most people whose day job is to invest in equities and sell equities, invest all their money in real estate. So what's the reason? Of course, these are smart human beings making rational choices. And I think the reason for that is Indian equities have underperformed. And we can have a long, the good news is it's going to change. But it's very important to understand why it has underperformed in the past and why it will change in the future. It has underperformed in the past because India has been a high inflation country. Equities cannot perform in a high inflation environment. India has been volatile and has seen high inflation. It's a unique country. There are very few countries in the world that have seen consistently high inflation for the last 70 years. India is one of them. And what's the hedge against inflation? Owning assets. So owning assets in India has done well. As an investment strategy, a superior investment strategy has been buying assets. No wonder most equity managers put their personal money in real estate. And why is this going to change? Because going forward, two things will come down. One is volatility in India is reducing, because volatility is the biggest enemy of long-term investing. Compounding is the eighth wonder of the world. So for private equity to work, you need 8, 10-year cycles of expansion. The longest cycle of expansion in India has been 5 or 6 years. And the second reason why equities is now coming to the fore, 10% of Indian households now invest in equities. They don't invest enough, but 10% do. That's a low number. In the US, 50% of households invest in equities, and a lot more of their savings in equities. So what will take 10% to 50%? A lower inflation environment. In low inflation, equities is the only way or a better way to create returns. And owning assets becomes an inferior way to create returns.
Thanks for that. Shifting to another important class, and maybe, Babar, that's a question for you. In the last few years, foreign sovereign wealth funds and pension funds have become an important asset class, investors in India in the private space, CPBIB, Abu Dhabi Fund, to name a few. So what is it that they look for, LPs like that, who come with very big checks? What is it that they look for? What are the returns they are expecting? And has India met those expectations?
So I'll talk about the asset class in general without any specifics. So I think when typically sovereign funds are looking at investing in countries for long terms, then the sovereign funds can take really long-term views. So if you think about a private equity asset class, it can take 7-8 year view on an investment. Given the fund cycle, they go to invest in the first 3.5, and then start exiting. Sovereign funds can take much longer. So sometimes they take 20-30 year views, especially when they're going into these different countries. And a lot of them also require a sort of portfolio balancing with a lot of long-term, perhaps lower return, but very long-term stable yield portfolios underneath that. So if you see, a lot of deals have happened in infrastructure, especially where there is a long tail of revenues, 20-30 year concessions underneath that. That has happened. The other way where sovereigns are investing is also in growth and late stage. There it will be typically with a private equity hat on, where the return expectations would be in a 5 to 7 year investment horizon, or longer if the company continues to do well, because you don't have to have a fund or end of fund life sort of event forcing an exit. But typically 5 to 7 years would be what it is. And I think it's too early to say, right? See, the last 3-4 years ago, the investments made, you'll start to see, the expectation versus reality. That check is usually at a, more like 5, 6, 7 year mark. But things seem to be on their way. We are not, we are not yet hearing any noise that too much has happened too fast. And some of the entities you just mentioned are, I think, too large also. And there is a lot of deployment coming and following through. So I think this should continue, is my sense.
So, yeah, you do feel the continued interest is going to be there, and they believe in the fundamentals of the country.
Correct.
That's great. Kirill, coming to you, there is a myth, or rather a stereotype in India that, it's a difficult place when it comes to exits, and there is no, I feel it's a myth, I think, our panel, but I'd love to hear what your view is and what your, where you come from. Because I know every LP, when they put their money there, the thing in their mind is, how do I exit? So would love to hear your thoughts on that.
Well, maybe I'm not the right person just because we don't have exits yet, but as I mentioned, we do have two of our portfolio companies on the M&A track. I must admit that I fully agree that there are, of course, concerns about liquidity in the market, but this year I think is a kind of it's a tipping point for the whole market with this major acquisitions happened, which we all know, and there is significant interest from abroad. Foreign investors started making big checks for Indian companies, and I do believe that we are now. I mean, probably probably this statement is attributable to pretty much all the years before, but I do believe that now is exactly the tipping point for the market, and in the next 2-3 years, the direct investments, venture capital and private equity, venture capital mostly, I'm speaking about venture capital mostly, will maybe not skyrocket, but at least will develop to the next level, and it will be kind of different league, I believe.
Thank Thank you. Gopal, would love to hear your views on this. I mean, you've had successful exits and that too, some of them through IPOs in the Indian market. And so would love to sort of hear your views on exits and what would your, I would say, advice would be for foreign investors when they talk about exits in India. Where do you see the exits coming from? Is it in the domestic market, strategic, financial investors? What is it looking for India?
Well, the good news is that the exit scenario has improved considerably in India, especially over the last 5 years. So until about 2012, 2013, one of the bigger challenges about investing in India was that exits weren't possible. And we'll talk about what's changed. I think 5 years later, the question has shifted. I don't think the fundamental question is exits anymore. Now the question is around returns. So what are the things that are working and what are the things that aren't working? The good news, again, is that there are some things that are working. IPO markets are working. IPO markets are working because domestic investors are investing in Indian equities. Secondaries are working because there are at least 20, 25 active global buyout firms that are looking to buy stakes and companies from other private equity firms. What isn't working, what is not yet working is the strategic piece, right? So let's say when 20 years ago, if you would speak to the typical private equity venture capital investor, even today if you look at a venture capital private equity investing in the US or other large markets, 2 out of 3 exits happen through the strategic route, which is you sell companies to other companies. So that isn't yet working in India, and that isn't yet working in India is because India's M&A markets are disproportionately small to the size of the economy. India's M&A markets are disproportionately small to the size of India's economy for a number of reasons, but probably relevant here, we're talking about international strategic investors and all, is the role that international strategics are playing in Indian M&A markets. So I'll stop here by saying that things have improved considerably over the last 5 years. The best part of the story is the presence of global buyout firms, is the deepening of the Indian IPO markets, and I do think things will change in the next few years on the strategic front, but so far Indian M&A markets are fairly small compared to the size of the economy, and that's the missing third piece.
Thank you for that. Moving on to, I think top of mind for everyone right now with the dollar, rupee slipping against the dollar is the currency headline. And I think it makes a big impact to the investors. Maybe a question for you, Ashish. I'm sure you've been asked this question, hundreds of times in the past month. Is, India being one of the worst performing currencies in the world right now, how are the investors looking at it? What does it mean for the current investors, and what does it mean for the enthusiasm for the investors who are looking at India seriously?
I don't think the rupee depreciation is a new phenomenon. I mean, rupee has depreciated over the last several decades. We've had, it almost follows a step function downwards, and we have passages where it really dips faster than others. So I think that tends to affect hedge funds and hot capital a lot more, which are working on leverage, etc., particularly overseas leverage. But from our asset class perspective, again, if you take a 10-year view, then I think you need to factor in that the rupee will depreciate. And you also will, as an economy, you will deliver returns to compensate for that depreciation. If you don't do that over a sustained period of time, then there will be no capital flows. So I think if you take a 10-year view, your returns in this asset class will more than compensate for rupee depreciation. And you need to, and I don't think there is any alarming issue for our LPs because a dip like that happens. And secondly, in our fund, we have technology companies which basically sell overseas, derive a significant portion of their revenues from overseas markets.
That's a natural hedge.
So that's a natural hedge. So we are not, I've not heard excessive alarm from our LPs in terms of.
Babar, what about, would love to hear your views, and I'm sure in your world LPs do a comparative analysis, so both, net returns, gross returns, so.
See, for us, it helps. We are an Asian entity, so we do know that in emerging markets there will be, the emerging market issues, and especially if you're an oil importing company, then there will always be that pressure on the trade balance, and there will be always pressure on the currency. So I think the right thing to do is for any investor to go in assuming that there will be depreciation of the rupee and embed that into the investments case. I think that is absolutely necessary. Now, whether you take over long term, whether it's 3, 4, 5% depreciation, something in that range you must embed, which we do in all our investment cases. So we've never been surprised on the negative side, but sometimes when the rupee does hold for 2 or 3 years and doesn't slide that much, we've actually been surprised on the positive side. So that I think the base case has to be in that range. But the second thing I would say is that, and this is all structural, right? The pressure on the rupee is because we are an energy importing nation. Well, there is a lot of advances going on now in solar energy, for example, and I am told that the cost of generation at least has now almost come down similar levels as fossil fuel. I guess once the battery and the storage costs also start getting at par, you could suddenly actually see very different dynamics. So while in the next 5 years, maybe even 7 years, you will have that pressure on the rupee, who knows, in 10 years' time, it may be the other way around. I don't know if it'll be good or bad, but it just may happen.
Yeah, I would like to just share, one interesting case study, like a bloodbath that happened in Russia some time back. So as you might know, Russia is heavy on the crude oil export. It's kind of our curse for the country. So what happened in 2014? The major message is basically that exchange rate can naturally ruin venture capital space, like ruin. So the case. So in 2014, oil prices fell 50%. Within 3 to 5 months, ruble, which is a Russian national currency, depreciated from 34 rubles per dollar to 60 rubles per dollar. And in the context of 95% of venture capital and private equity funds raising money in the US, and most of the funds, like 80% of the funds, are region-focused funds, like Russia-specific funds, with all the portfolio companies generating revenue in national currency. All the significant part of venture capital and private equity ecosystem has been reevaluating their portfolio like 2 times naturally within 4 or 5 months. Can you imagine that? I mean, this was a nightmare, really. But I mean, good thing is that was a kind of a perfect storm, right? So what happened in 2014? That was decrease in the oil prices. So it was oil shock, and there was something else. There was annexion of Crimea. There was some kind of Ukraine conflict, Russia-Ukraine, and as a consequence of that, there were sanctions, and that was a very bad kind of time, which naturally ruined venture capital and private equity.
That's interesting. Thanks for sharing that. Gopal, I know you're a private equity investor, but in any growth story, I think credit becomes very important at some point. And I think it's time in the Indian startup ecosystem that we start looking and preparing for how we're going to support, credit is going to support these young companies. You know, our banking system is under stress and, you know, it's still not out of the woods. Also, they are not probably prepared and ready to do such a specialized class. So what steps do you think, reform steps, you know, what should be the system and what should the key investors be doing to ensure that there is enough credit available to fund India's growth story?
I don't think there is much that people sitting on this side of, but it's a very important question. If you see the Indian growth story over the last 70 years, credit as a player has been conspicuous by its absence. If you study the history of capitalism over the last 500 years, one of the primary players in the story of capitalism is the role of credit. And credit is almost absent in India for the private sector. So of course it needs to change. And what's going to make it change? Right? A number of factors will make it change. And again, I think we are headed in that direction. And we as a country, as a nation, as a people, policymakers should think about how we can accelerate the change. The first is that the usurpation of savings by the state, right? So that's coming down. Good news is that's coming down. The second is the ownership of the banking system. Good news is that's changing, right? The third is inflation. So we are, for the first time, in the last 70 years, there is a discourse around, hey, listen, we need to reduce inflation. Therefore, lower interest rates. So I see the confluence of these three factors finally creating an ecosystem. So we in Gaja Capital, we have a word for it. We think India is facing its telecom moment in banking. So what's that telecom moment in banking? 20 years ago, I keep speaking like an old man, right? 20 years ago, 1996, India had 5 million telephones. Can you believe that? I'm not making this up. 5 million telephones, right? You would have all heard of stories of how people would visit each other's houses. And I was privy to that. I was fortunate. I was born in a bureaucrat's home, so we had telephones, but we had relatives visiting us wanting to make calls. 5 million telephones. Today, India has 1.5 billion telephones. What changed that, right? Two things changed that. One is technology. The other is the role of the private sector. And the same two factors are right now creating a telecom moment in banking. So just as in the last 20 years, technology and the private sector put a telephone in almost every Indian's hands. Actually, 20% of Indians still don't have a mobile phone, but at least 80% of Indians' hands. It won't take 20 years, and you will see a profound change in the next 10, 15 years in terms of the availability of credit for the average Indian business, and it will also have a profound impact on our business models and the use of credit in our business. So the stage is set, and the changing role of the private sector in India's banking system and technology, this telecom moment in banking, it's one of the most profound changes in India that's happening right now. And we are so excited. We are participating in it in so many ways. All of us are participating in it in so many ways, and we are seeing it right now.
Great, thank you. What about your views on this? Do you think credit is an important component in your companies and to fund growth in India?
See, you hit it on the head. See, the credit accessibility for companies which are already scaled up is easier. They can go into the formal banking system. But those who are in the early stage of growth, perhaps even take in venture funding, sometimes it's hard for them. Even though they may have a very legitimate need for either, expanding their stores and the capex for that, or having working capital for their inventory. And both inventory and capex the formal banking sector very normally provides credit for, but only if you are scaled up. So the early stage companies, in spite of having a very legitimate need against which the collateral also really exists, but just because they're young and small, do not get that. So I think there is room for having credit funds or credit entities which provide credit only to the early stage. Perhaps the yields could be higher, given they take slightly more risk, and there could also be structures whereby they take an upside when the company grows into the next stage of their life cycle.
And I have my final question for the day, which I'm going to open to the panel, and let's see who puts their neck out. Has India disappointed or exceeded the expectations of the global private investor market? And I know we've touched upon this, but do you think, how are the investors feeling? I think, of course, we have signs of optimism, we have signs of people coming forward, but what is it that the investors are feeling right now? Are they happy about it? Are they apprehensive about it?
No, I can say very short answer. So I think the issue is that when you look at the average, then when you look at the averages may be very misleading. So there are some pockets and some sectors which obviously have disappointed. And if you're too long and too heavy into something like infrastructure for too long, then maybe, but then that's something, those things take the averages down. But if you're in something where, for example, healthcare or consumers, which have very long tailwinds in India, I think you will do better than average, and therefore your experience would be a lot better.
Great, thank you.
A country arrives as an investment destination when performance is the rule, not an exception to the rule, right? So let me say that again. A country arrives as an investment destination when you don't have to be an Einstein to make money, when everybody can make money, right? I'm excited about the future. I've been investing for 30 years, and I'm going to invest for another 30 years because I'm excited about the future. But so far as a country, we haven't delivered on our promises. We haven't delivered on our promise. Our tryst with destiny hasn't happened. We can still have a tryst with destiny. We can all work towards the much deserved, much promised, and in something in which I have deep conviction that we do have a tryst with destiny. We have a destination, a great destination as a country. And for that to happen, performance has to become. There are many reasons why, some of the conditions that disappointed us in the past are no longer applicable in the future. So I'm excited about the future, but India certainly hasn't exceeded its expectations as far as the past is concerned.
Interesting. Ashish?
No, I agree, with Gopal and Babar. But let's look at it another way. I'm just trying to put another lens here. Investors' psychology works on greed and fear, right? I think if you talk to investors, I think there are plenty of stories of disappointment. That's not, there's no dearth of them. But at the same time, we have seen capital flows over a increase and continued, right? At this point, I think in balance, investors are excited about India. They can see a story playing out. And like Gopal said, it is for us to deliver and make that much more sustained and continuous so that we don't have to ask the question. But I think there is a desire, or there is a desire to invest in India, and I think people can see the positive story.
With that, I open the forum for any questions. We have a few minutes. I think we are running a bit tight on time, but we'd like to take a few questions.
A question for Gopal, and perhaps he can answer both related questions. You mentioned that volatility is expected to go down, but management literature says that this is going to become more and more of a VUCA world, globally as well as in India. So are you only referring to the stock market? That's number one. And number two, the big boys in private equity, you know, the Bain Capital, KKRs, etc.
Referring to the volatility piece that you're referring to is episodic volatility. Coming to India, the reason why India's volatility will reduce over a period of time is for two reasons. One is a structural reason, the source of volatility. It's a longer discussion, and I won't go into it, but suffices to say that that is a function of how we manage our twin deficits, right? Our current account deficit, right? And our fiscal deficit. And the management of these two current account deficits is improving. We have one guardrail in place, we need a second guardrail. The second guardrail won't arrive, but thank God we have one guardrail, which is the monetary policy framework. The second part of why volatility in India will reduce, in science, there is the science of large objects, large systems, right? Large objects and large systems, with size, systems become more stable. Episodic volatility increases, but they become more stable. So as we're becoming a larger economy, we're becoming more stable, right? This is well documented, well understood. Science has spent a lot of time on these things. The second part, you know, it's not for me to comment on, and I don't know what you're referring to. We work alongside these investors. We look, you know, I have access. We've had great results. It's not a question of how Gaja Capital does or how Bain Capital does. Or A Capital does or B Capital does. I think what's being talked about here is how private equity as an asset class is done. And please try and understand that a country arrives as an investment destination when the asset class does well, right? Exceptions, there'll always be exceptions to the rule. But that is not good enough to attract global capital or even domestic capital. So an asset class comes of age when an asset class does well. And when this happens is that the curves need to flatten out, which means more and more managers need to make money. Not just the super smart GPs, but even the less smart GPs. You know, I'm just giving you a way to understand this. So this is not about how A investor does, B investor does, or Gaja Capital does. The reason I've been investing for the last 30 years is obviously perhaps because we've been doing well. It's really about the asset class. The asset class needs to do well.
Thank you. I think sure.
To add quickly, just minor comments. So first of all, private equity and venture capital cannot be kind of directly compared, just because private equity at least assumes zero mortality for the investments. In venture capital, you can expect certain mortality, right? And secondly, which is also kind of interesting aspect, is you have to compare each performance of each asset class to public market equivalent. And there's another problem here in India, and it was the same problem in Russia when public equities provided better returns than venture capital asset class. So and for typical investor, it's a big question. Why would you take a lot of risk and invest in the startups, whereas you can allocate your money to kind of blue chips and have kind of greater returns? So I fully agree. I mean, that's you should compare asset class, and you should monitor each asset class. You should compare it to public market equivalent, and at the same time you have to understand what are the key concepts of each and every asset class. So.
Thank you, gentlemen. This has been a very